The book Common Stocks and Uncommon Profits by Philip A. Fisher outlines his investment philosophy based on the search for companies with exceptional growth potential. Fisher believes that companies capable of growing at a rate higher than the market average offer the best long-term investment opportunities. To identify these companies, Fisher proposes a series of criteria that must be met. Superior leadership. The company must be led by a management team with a track record of success and a clear vision for the future. Sustainable competitive advantage. The company must have a competitive advantage that allows it to maintain profitability over time. Attractive market. The company should operate in a growing market or one with the potential for growth. Fisher also emphasizes the importance of fundamental research when investing. Investors should dedicate time to analyzing the companies they are interested in to understand their business, competitive environment, and growth prospects. Fisher's investment principles have been followed by many successful investors, including Warren Buffett. Buffett has said that Common Stocks and Uncommon Profits is the best book on investing I've ever read. In Spanish, the book Common Stocks and Uncommon Profits has been translated as Acciones Ordinarias y Beneficios Extraordinarios. Some of Fisher's most important advice for investors includes: invest in companies with exceptional growth potential. Thoroughly research the companies you're interested in. Be patient and do not let emotions dictate your decisions. Common Stocks and Uncommon Profits is essential reading for any investor looking to learn how to invest successfully for the long term. Chapter 1. Introduction. In this chapter, Fisher introduces his investment philosophy based on the search for companies with exceptional growth potential. Fisher believes that companies capable of growing at a rate higher than the market average offer the best long-term investment opportunities. Fisher points out that growth is the most important factor to consider when investing. Companies that grow at a rate higher than the market average are more likely to generate above-average returns. Fisher also emphasizes the importance of fundamental research when investing. He believes that investors should dedicate time to analyze the companies they are interested in to understand their business, competitive environment, and growth prospects. The importance of growth. Fisher believes that growth is the most important factor to consider when investing. The need for research. Fisher emphasizes the importance of fundamental research when investing. Examples. Fisher mentions Coca-Cola as an example of a company with exceptional growth potential. Coca-Cola is a leading company in the beverage industry and has a globally recognized brand. Fisher also mentions Xerox as an example of a company with exceptional growth potential. Xerox was one of the first companies to develop the photocopier and was a major technology company during the 1960s. Fisher's investment philosophy is based on the search for companies with exceptional growth potential. Fisher believes that this strategy can be highly profitable, but it is important to be patient and disciplined to succeed with it. Investors who follow Fisher's advice and focus on the growth of the companies they invest in have a good chance of achieving exceptional long-term returns. Chapter 2. The investment process. In this chapter, Fisher explains the steps that investors should follow to identify and select companies with exceptional growth potential. Steps. Identify growing industries. The first step is to identify industries that have the potential to grow at a rate higher than the market average. Identify industry leaders. Once growing industries are identified, the next step is to identify the leading companies within those industries. Conduct fundamental research. The final step is to conduct fundamental research on the identified industry leaders. This research should include an analysis of the following factors. Performance history. Investors should analyze the company's performance history to understand its ability to generate profits. Capital structure. Investors should analyze the company's capital structure to understand its level of risk. Competitive advantage. Investors should analyze the company's competitive advantage to understand its ability to maintain profitability over time. The importance of diversification. Fisher believes that diversifying investments is important to reduce risk. Investors should invest in a portfolio of companies operating in different industries and with different levels of risk. Patience. Fisher emphasizes the importance of patience when investing. Investors should be prepared to wait for their investments to appreciate. Fisher mentions the aviation industry as an example of a growing industry. This industry has the potential to grow as the world population increases and becomes wealthier. Fisher also mentions General Motors as an example of a company leading its industry. General Motors is one of the world's leading automobile manufacturing companies and has a long history of success. Fisher's investment process is a systematic approach that can help investors identify companies with exceptional growth potential. Investors who follow Fisher's advice and follow the steps described in this chapter have a good chance of achieving exceptional long-term returns. Chapter 3. Superior Leadership. In this chapter, Fisher emphasizes the importance of a management team with a track record of success and a clear vision for the future. Fisher believes that companies led by a strong management team are more likely to succeed in the long term. The importance of experience. Fisher believes that business leaders should have experience in the industry in which they operate. Experienced leaders are more likely to understand the intricacies of the business and make sound decisions. The importance of vision. Fisher believes that business leaders should have a clear vision for the future. Visionary leaders are more likely to guide their companies towards success. Fisher mentions Walt Disney as an example of superior leadership. Disney was the founder of the Walt Disney Company and was responsible for turning it into one of the most successful entertainment companies in the world. Fisher also mentions Jack Welch as an example of superior leadership. Welch was the CEO of General Electric for 20 years and was responsible for transforming the company into one of the most successful companies in the world. Superior leadership is an important factor that can contribute to the success of a company. Investors should look for companies led by experienced and visionary management teams. Investors who follow Fisher's advice and focus on companies with superior leadership have a good chance of achieving exceptional long-term returns. Some examples of companies with superior leadership. Apple. Tim Cook has been the CEO of Apple since 2011. Cook has led Apple during a period of great growth and success. Amazon. Jeff Bezos is the founder and CEO of Amazon. Bezos has transformed Amazon from an online bookstore into one of the largest and most successful companies in the world. Microsoft. Satya Nadella has been the CEO of Microsoft since 2014. Nadella has led Microsoft during a period of transformation and growth. These are just a few examples of companies with superior leadership. Investors who seek out companies with superior leadership have a good chance of finding companies with exceptional growth potential. Chapter 4. Sustainable Competitive Advantage. In this chapter, Fisher explains that companies with a sustainable competitive advantage are more likely to succeed in the long term. Fisher defines sustainable competitive advantage as a characteristic or factor that enables a company to achieve above-average profitability within its industry over time. The importance of exclusivity. The competitive advantage must be exclusive to the company. If the advantage can be replicated by other companies, then it will not be sustainable. The importance of durability. The competitive advantage must be durable. If the advantage can be eroded by changes in the competitive environment, then it will not be sustainable. Coca-Cola has a globally recognized brand that gives it a sustainable competitive advantage. Amazon has scale and operational efficiency that give it a sustainable competitive advantage. Sustainable competitive advantage is an important factor that can contribute to a company's success. Investors should look for companies with a sustainable competitive advantage. Investors who follow Fisher's advice and focus on companies with a sustainable competitive advantage have a good chance of achieving exceptional long-term returns. Some examples of companies with a sustainable competitive advantage. Coca-Cola. Coca-Cola is a leading company in the beverage industry and has a globally recognized brand. Coca-Cola's brand is a sustainable competitive advantage because it is unique and enduring. Amazon. Amazon is a leading company in e-commerce and has scale and operational efficiency that give it a sustainable competitive advantage. Amazon's scale and operational efficiency are unique and enduring. Microsoft. Microsoft is a leading company in software and has a sustainable competitive advantage based on its intellectual property. Microsoft's intellectual property is unique and enduring. These are just a few examples of companies with a sustainable competitive advantage. Investors who seek out companies with a sustainable competitive advantage have a good chance of finding companies with exceptional growth potential. Chapter 5. The Timing of Purchase. In this chapter, Fisher explains that the timing of purchase is as important as selecting the right company. Fisher believes that investors should wait for a stock price to be attractive before buying it. The importance of valuation. Investors should conduct a valuation of the company before buying its stocks. Valuation should take into account the company's fundamental factors, such as its revenue, earnings, and growth. The importance of patience. Investors should be patient and wait for a stock price to be attractive before buying it. Fisher mentions Xerox as an example of a company that was purchased at an attractive price. Xerox was a leading company in the photocopier industry and its stocks were bought at a relatively low price compared to its growth prospects. The timing of purchase is an important factor that can contribute to the success of an investment. Investors should wait for a stock price to be attractive before buying it. Investors who follow Fisher's advice and are patient when buying stocks have a good chance of achieving exceptional long-term returns. Some tips for buying stocks at an attractive price. Buy stocks when the market is bearish. When the market is bearish, stock prices tend to be more attractive. Buy stocks of companies with a solid growth track record. Companies with a solid growth track record tend to be more resilient to market downturns. Buy stocks of companies with a sustainable competitive advantage. Companies with a sustainable competitive advantage tend to have a higher intrinsic value than their current price. These are just some tips for buying stocks at an attractive price. Investors who follow these tips have a good chance of finding attractive investment opportunities. Chapter 6. The Margin of Safety. In this chapter, Fisher introduces the concept of margin of safety. The margin of safety is the difference between the intrinsic value of a stock and its current price. Fisher believes that investors should look for companies with a significant margin of safety. This means that investors should buy stocks at a price significantly lower than their intrinsic value. The importance of intrinsic value. The intrinsic value is the true value of a stock. Intrinsic value should take into account the fundamental factors of the company, such as its revenue, earnings, and growth. The importance of margin of safety. The margin of safety is a measure of investment safety. A significant margin of safety reduces the risk of an investment. Fisher mentions Coca-Cola as an example of a company with a significant margin of safety. Coca-Cola has a solid growth track record and a sustainable competitive advantage. Its intrinsic value is much higher than its current price. The margin of safety is an important concept that can help investors make safer investment decisions. Investors who follow Fisher's advice and seek out companies with a significant margin of safety have a good chance of achieving exceptional long-term returns. Some tips for calculating the margin of safety. Use a formula. A simple formula for calculating the margin of safety is as follows. Margin of safety equals intrinsic value, current price. Use a valuation. Investors can also use a valuation to estimate the intrinsic value of a stock. These are just some tips for calculating the margin of safety. Investors who follow these tips have a good chance of finding attractive investment opportunities. Chapter 7. The Active or Entrepreneurial Investor. In this chapter, Fisher distinguishes between two types of investors. The passive investor. The passive investor seeks to buy stocks at an attractive price and hold them for the long term. The active investor. The active investor seeks to buy and sell stocks frequently, aiming to make short-term profits. Fisher believes that the passive investor is the best choice for most investors. The passive investor is more likely to achieve exceptional long-term returns with lower risk. The importance of patience. The passive investor must be patient and wait for a stock price to be attractive before buying it. The importance of diversification. The passive investor should diversify their portfolio to reduce risk. Fisher mentions his own father, Jesse Livermore, as an example of an active investor. Livermore was a stockbroker who made and lost a fortune in the stock market. The passive investor is the best choice for most investors. The passive investor is more likely to achieve exceptional long-term returns with lower risk. Some tips for the passive investor. Buy stocks of companies with a solid growth track record. Companies with a solid growth track record tend to be more resilient to market downturns. Buy stocks of companies with a sustainable competitive advantage. Companies with a sustainable competitive advantage tend to have a higher intrinsic value than their current price. These are just some tips for the passive investor. Investors who follow these tips have a good chance of achieving exceptional long-term returns. In this chapter, Fisher also offers some tips for the active investor. The active investor must have a deep knowledge of the stock market. The active investor must be able to make investment decisions quickly. The active investor must be able to withstand losses. These tips are important for the active investor, but Fisher believes that most investors should be passive. Chapter 8. The Psychology of the Investor. In this chapter, Fisher explains that human psychology can play a significant role in investment decisions. Fisher believes that investors should be aware of their own emotions and how they can affect their investments. Fear and greed. Fear and greed are two emotions that can lead investors to make irrational decisions. The importance of discipline. Investors should have discipline and avoid being swayed by their emotions. Fisher mentions the Panic of 1929 as an example of how fear can lead investors to make irrational decisions. Human psychology can play a significant role in investment decisions. Investors should be aware of their own emotions and how they can affect their investments. Some tips for managing emotions. Establish an investment plan. An investment plan will help you stay disciplined and avoid being swayed by your emotions. Use stop-loss limits. Stop-loss limits will help you limit your losses if the market moves against you. Don't check your investments too frequently. Checking your investments too frequently can increase your anxiety and lead to irrational decisions. These are just some tips for managing emotions. Investors who follow these tips will be better prepared to make rational investment decisions. In this chapter, Fisher also offers some tips for avoiding the most common psychological traps. Don't try to predict the market. It's impossible to predict the market accurately, so trying to do so is a waste of time and money. Don't follow others. Follow your own research and don't be swayed by the opinions of others. Don't obsess over short-term gains. Focus on long-term gains and avoid being swayed by short-term market fluctuations. These tips are important for avoiding the most common psychological traps. Chapter 9. Long-Term Investment. In this chapter, Fisher emphasizes the importance of long-term investment. Fisher believes that investors should be prepared to wait for their investments to appreciate. Fisher points out that the stock market is unpredictable and stock prices can fluctuate significantly in the short term. However, Fisher believes that in the long term, the stock market tends to rise. Fisher recommends that investors focus on the growth of the companies they invest in, rather than on short-term market movements. Fisher believes that if investors invest in companies with exceptional growth potential, their investments will appreciate in the long term, regardless of market fluctuations. Fisher also recommends that investors be disciplined and not sell their investments too soon. Fisher believes it is important to have patience and wait for investments to appreciate. The importance of patience. Investors should be prepared to wait for their investments to appreciate. The importance of discipline. Investors should be disciplined and not sell their investments too soon. Fisher mentions Warren Buffett as an example of a long-term investor. Buffett has been one of the most successful investors in the world, and his success is partly due to his long-term approach. Buffett has invested in companies such as Coca-Cola, American Express, and Berkshire Hathaway, and has held these investments for many years. These companies have generated exceptional returns for Buffett's investors and are likely to continue to do so in the future. Long-term investment is an investment strategy that can be very profitable. However, it is important to be patient and disciplined to succeed with this strategy. Investors who follow Fisher's advice and focus on the growth of the companies they invest in have a good chance of achieving exceptional long-term returns. Chapter 10. Long-Term Investment. In this chapter, Fisher explains that long-term investment is the best strategy for most investors. Fisher believes that investors should focus on long-term gains and avoid trying to predict the short-term market. The importance of patience. Investors must be prepared to wait for their investments to appreciate. Long-term investment requires patience. Investors must be willing to wait for their investments to grow. The importance of discipline. Investors should be disciplined and not sell their investments too soon. The importance of diversification. Diversification reduces investment risk. Investors should diversify their portfolio to reduce the risk of total loss. Invest in companies with exceptional growth potential. Thoroughly research companies you're interested in. Be patient and don't let emotions sway you. Fisher mentions Warren Buffett as an example of a long-term investor. Buffett is one of the most successful investors in history and has achieved his significant gains by focusing on long-term investment. Long-term investment is the best strategy for most investors. Long-term investment requires patience and diversification, but it can yield significant gains. Some tips for long-term investment. Buy stocks of companies with a solid growth track record. Companies with a solid growth track record are often more resilient to market downturns. Buy stocks of companies with a sustainable competitive advantage. Companies with a sustainable competitive advantage often have a higher intrinsic value than their current price. These are just some tips for long-term investment. Investors who follow these tips have a good chance of achieving exceptional long-term returns. Fisher also offers some specific tips for long-term investment. Set a performance goal. It's important to set a performance goal before you start investing. This will help you stay motivated and make rational investment decisions. Reinvest dividends. Reinvesting dividends is a simple way to increase your wealth over the long term. Don't sell your stocks when the market is bearish. The stock market will rise and fall over time. It's important not to sell your stocks when the market is bearish. These tips are important for long-term investment. The book Common Stocks and Uncommon Profits is essential reading for any investor who wants to learn how to invest successfully in the long term. Overall, Common Stocks and Uncommon Profits is an excellent book that can help investors improve their results. Thank you for joining this exploration of Common Stocks, Uncommon Profits. Remember, knowledge is the first step towards change. Now, I invite you to share in the comments which lesson impacted you the most. Don't forget to subscribe for more content on financial education and personal development. Together, we'll build a path to financial freedom. See you in the next video.